Hi there, welcome back to Dukascopy TV. I'm Ben Jones. On the line with me today to review yesterday's FOMC meeting minutes is Mike Jakeman from the Economist Intelligence Unit. First of all, Mike, from the meeting minutes, what can we tell about when the rate hike will be?
Well, we have our view at the EIU that we think rates will be first raised in the third quarter of next year. But actually, the minutes from this meeting are actually sort of less helpful than you might expect in determining whether or not that view is accurate. And the reason is because since the meeting, which took place in mid-December, we had data for the preliminary data for Q3, which showed that the economy grew by 5%. Which was much in excess of what we were expecting, and indeed probably what the Fed was expecting. They talk in their minutes about the likely moderate growth, and in fact it exceeded that. So actually, it's possible that the Fed are now going to change their mind and bring that rate call forward as a result of a faster growth. So this gives us an insight to what they were thinking prior to that latest set of growth figures, but there's a reasonable chance that might have changed.
Now, there was a hint that rates will be raised even before inflation picks up. What negative implications would this bring? Yeah,
I mean, the trouble with inflation, and obviously they're trying to do the two things and bring unemployment down and lift inflation before they raise rates, is that global oil prices have obviously tumbled and are now less than half what they were 6 or 7 months ago, which means that that's a huge negative effect on inflation in the US. I would actually venture that the more important thing for the Fed is probably unemployment and real wage growth. And we've seen very moderate wage growth for the past year or so. In the next 6 months or so, given that unemployment is now down to less than 6%, we should see real wages start to rise. And that will mean that the Fed will be more confident about raising rates because obviously with more wages, people are more likely to spend more money and keep the economy on a kind of even keel.
And finally, what else was mentioned that you think is key?
I think that the things that probably emphasised from the minutes is this likelihood that the Fed is going to continue to behave quite dovishly and be patient. We didn't change our call for the first rate rise in Q3 of 2015 after the GDP data. We haven't brought it forward because we think that the Fed is quite committed to seeing a really sustained recovery, not just in headline terms, but also in terms of real wages. So I think last year Janet Yellen mentioned the willingness to let the economy run ahead of some of its target indicators before it raises interest rates. And I think that there's nothing in the statement that sort of changes that view.
Mike, thank you very much for joining me on the line today. That's all we have time for now. Thank you for watching, and make sure you keep clicking back to Dukascopy TV for plenty more updates and exclusive interviews. Bye for now.